Welcome everyone to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. I'm absolutely thrilled to have you with us today. As always, we're putting on our clinical hats to diagnose and treat some truly complex accounting issues. We're going to take those dense, complicated regulatory texts and transform them into clear, actionable knowledge. Today, we're looking at a fascinating case. It involves, well, the ghosts of accounting periods past, and we're going to break down exactly how to handle them.
But before we open up our patient's file, let's just lay down our standard clinic ground rules. The views expressed in this explainer are the personal views of the author, so they are not binding on the audience. We always request that you seek the help of a professional expert before taking any action or, refraining from any action based on the views we discussed today.
Okay, next up, let's quickly establish our baseline metrics so we're all speaking the exact same financial language. For us, our functional currency and presentation currency is the Indian rupee. So, simply put, any currency other than our functional currency is treated as foreign currency.
To finish setting up our baseline, we need to anchor ourselves in time. The beginning of our reporting period is strictly the 1st of April, and the end of our reporting period lands on the 31st of March. Keeping this strict 12-month window in mind is absolutely crucial to understanding exactly why a missed entry in a past year creates such a massive headache for us today.
All right, here's our patient care plan for today. We'll kick things off with the missing deposit interest, move into defining prior period errors, and then prescribe retrospective restatement. After that, we'll look at the Gap Advisors ecosystem and finish up with a reminder to keep learning and sharing.
Let's jump right into Section 1 and examine our patient's symptoms, the missing deposit interest.
So, let's look at the specific clues of our case study, which, by the way, was actually featured in the 220th edition of the Gap Advisors Task Weekly newsletter. Here are the facts. A company completely omitted the interest on their electricity consumption deposit. This omission happened while they were finalizing their accounts for the 2022-2023 reporting period. And it wasn't just the interest they missed. The omission also included the tax deducted at source, or TDS, made by the Electricity Corporation for that exact same year.
Which brings us to the real dilemma staring us right in the face. How do we account for this 2022-23 omission in the current year? I mean, we're basically financial time travelers stuck in the present. We can't just casually slip it into this year's current income, right? It doesn't belong to this year's performance. So what's the cure?
To figure that out, we need to open up our medical text, the Indian Accounting Standards, in Section 2, Defining Prior Period Errors.
Let's look directly at Ind AS 8. It literally states, prior period errors are omissions from and misstatements in the entity's financial statements for one or more prior periods, arising from a failure to use or misuse of reliable information. It also specifies that this includes oversights, misinterpretations of facts, mistakes in applying accounting policies, and of course, fraud.
And this brilliantly illustrates the core criteria of our diagnosis. For an omission to actually be a prior period error, that reliable info had to be available when the financial statements for those periods were approved for issue. Plus, it could reasonably be expected to have been obtained and used. For our patient today, we have to assume the company absolutely had sufficient information to accrue that interest on the electricity deposit in the previous period. They just flat out missed it.
So since we've confirmed the diagnosis is indeed a prior period error, let's turn to Section 3, Prescribing Retrospective Restatement, guided by paragraphs 41 and 42 of Ind AS 8.
The standard does not mince words here. It dictates that an entity shall correct material prior period errors retrospectively in the first set of financial statements approved for issue after their discovery. Retrospectively. That's the magic word right there. You don't just dump the fix into the current year. You have to go backward to treat the root of the problem. Let's see how this breaks down into a strict three-step procedure. Step 1, identify the material prior period error. Well, we've done that. Step 2, restate the comparative amounts for the prior period presented in which the error occurred. And Step 3, if the error happened even earlier than your earliest presented period, you actually have to restate the opening balances of assets, liabilities, and equity for that earliest prior period.
Bringing it all together for our electricity deposit case, here's our final clinical prescription. Diagnosis. The company made an error in their prior period financial statements. The treatment, mandated by Ind AS 8, restate the previous period reported numbers. And the desired result is that by doing so, the company will properly give effect to the unaccounted interest on the deposit and the associated TDS. This ensures their comparative financial history is perfectly healthy and accurate.
Now that our patient is cured, let's talk about preventative care in Section 4, the Gap Advisors ecosystem. Consider this massive number for a second, 4,500. The specific issue and response we just discussed was drawn directly from the incredible issue repository on gapeadvisors.com. That site currently hosts over 4,500 issues and detailed responses regarding Indian accounting standards and Indian GAAP.
And what's truly amazing is how accessible this whole repository is. Any person can register for absolutely free on gapeadvisors.com and submit their own issues on Ind AS and Indian GAAP. You'll get a detailed response delivered straight to your registered email inbox. It's an incredibly powerful tool. Actually, it's particularly crucial for auditors who really need to rigorously document exactly how they addressed any issue relating to the application of Ind AS.
Here's another vital number for your continuous learning, 230. As I mentioned earlier, today's explainer discusses an issue featured in the 220th edition of the Gap Advisors Task Weekly newsletter. This newsletter is authored by CA Manish C. Iyer, Director of Gap Advisors, and it's published regularly on LinkedIn. To date, over 230 editions of this highly informative weekly newsletter have been published.
So, if you're on LinkedIn, I highly encourage you to subscribe to the Task Weekly newsletter for free right now. And to really solidify your understanding, please connect to the Gap Advisors Ind AS Clinic podcast. It's available right now on Spotify, Amazon, or right here on YouTube for fantastic deep dives into the exact issues we deal with in these explainers.
Which brings us to our final section for today. Keep learning and sharing.
I want to sincerely thank you all for your time today. If you found this clinical breakdown helpful, please drop a like and add some comments to this explainer. And definitely make sure to subscribe to the Gap Advisors Ind AS Clinic channel if you haven't already. Most importantly, we request that you share this explainer among your contacts, your colleagues, your audit and finance teams, and especially with students pursuing their CA course. Together, we can spread the knowledge of Indian accounting standards far and wide.
I'll leave you with this final thought to ponder as you look at your own reporting timelines. Will your next audit catch the ghosts of prior periods, or will they slip by unnoticed? Armed with Ind AS 8 and the right resources, I'm confident you'll be ready for them. Until next time, stay curious and keep learning.